So are you seeing how this is working? Yep. The easiest thing, just learning from a whiteboard. Yay. What's 8,000 divided by 60?
That would be about 133.3333.
Alright, cool. Hi guys, welcome back to my channel. So today we're going to be talking about a very, very highly requested topic. So today I'm going to be speaking about taking out a car on finance. Now, I know this is something that is becoming so very popular in the UK amongst us young people. However, a big problem at the moment is that we just don't know what we're taking out. If you're someone that has already got a car on finance, you can, after this video, go away and double check anything that you didn't know, or check things that you just didn't know existed. If you're someone that's looking to take out a car on finance, then hopefully this video really does help you out and helps you to understand what type of car finance you should be looking for. I've already got the nice little title ready for us to learn, so yeah, let's get started. If you're anything like me, when they told me do I want a PCP or hire purchase vehicle, I honestly said just give me what the best option is, and I put way too much responsibility on the dealership, who luckily didn't but could have done everything in their best interests. So it is important that you guys are clued up, because at the end of the day, the people that sell you cars are salespeople. They have a job to make commission. They have a job to sell cars. So if you go in there and have absolutely no idea what you're talking about or what you want, they are more than likely going to sell you something you do not necessarily need. But first of all, you need to know that all motor finances are on a fixed loan term. A loan term, for those that don't understand, is how long your finance is for, whether it be 12 months, 24 months, 48 months, or 60 months. That is what a fixed term loan is, and it won't change. The only way that it can get shorter is if you settle your account early. You cannot call up a year into your car finance and say, oh, I'd like to change my loan term, can I reduce it by a year and I'll pay higher direct debits. That's not how it works. So be aware that the loan term you take out at the start is the loan term that you will be paying until the end. There are two types of motor loans that an individual can take out, and they are either leisure loans or non-leisure loans. So a leisure loan is anything like caravans or holiday vehicles that you are taking out for your leisure. Non-leisure vehicles on finance are obviously cars, vans. Okay, so as a young person, you are more than definitely going to want to take a non-leisure fixed term motor finance out. So the next thing you need to know is that there are two types of non-leisure loans, and they are unsecured loans and secured loans. An unsecured loan is when you take out a loan sum of money and you are using that money to finance your car. So you can go to a bank and say, I need a loan of £10,000 for a car that I want to buy. They will give you that loan, however they will not attach it to the vehicle. So in their eyes, you just have a loan out with them. It's up to you what you want to go and do with that £10,000. The risks will be that it's probably a bit more expensive, the interest rates will be higher, and it's a little bit more of a risky situation because that lender doesn't know what you've used the money for. The plus side of an unsecured loan is that you own the vehicle from day one. So if you were to miss payments on an unsecured loan, they don't have the right to take your car because they don't own the car, you own the car. So a secure loan is, however, attached to the vehicle that you are taking out, and it is a bit of it is less of a risk to the lender and yourself, because that vehicle then provides security against the loan. That lender or that lending company know exactly what you have gone to use that money for. So they tend to have much lower interest rates and they tend to be cheaper. They also usually offer higher loan amounts than an unsecured loan. However, they own the car. So you do not own the car until the final payment is cleared. I would highly recommend that you look out taking a secure loan. If worst comes to worst, they can always take the car and you do not have to make any more payments, as opposed to if it was an unsecured loan, you will be in that debt until you pay that money off. We will not look at unsecured loans. So far we have learned that we are going to take out a fixed, non-leisure, secured motor loan, and this is where the choice kind of gets left up to you. So what you need to now know is that there are two types of secured loans, and this is where I think most young people get really confused and we panic. This is where they ask you,
do you want a hire purchase loan or do you want a PCP?
if you're anything like me, again, I just said PCP because I hear people talk about it more than I hear people talk about hire purchase. So don't be like me. Learn your facts, learn what you need to know so that you are in a very good position when you're ready to take out a car. The first one is called a conditional sale. Also, you guys may know of it as a hire purchase agreement. And the second one is the famous PCP, which actually stands for personal contract purchase for those that don't know. I was one of those that didn't know. With a hire purchase, you have the amount. You pay a deposit and then the rest is split up into monthly instalments. With a PCP, so you have your initial deposit at the beginning. They then put the balloon amount at the end, and the balloon amount is the estimated value of the car after those years. So if you take out a car today, obviously, as you guys should know by now, a car will depreciate in value quite significantly over time. So the balloon amount is usually the worth of the car at the end of that loan term. So they will put that value at the end, and here you will pay your minimum instalment. So you'll pay your monthly instalments.
So let's think if this was £10,000 loan and this was £2,000 deposit. So this is £8,000 loan. So you will pay over 5 years. It'll be 60 payments of £133 will give you that £8,000.
With a PCP, for example,
let's do the same example. You've got a £10,000 car loan. You've paid £2,000 deposit at the beginning.
and it can always be less. Because they've added the balloon amount on top, your deposit is usually more likely to be quite a small amount.
So you've got the car for £10,000, you've paid £2,000 deposit. That leaves £8,000 remaining on loan. Let's say they value the car at £4,000 at the end of the 5 years. So they will put this figure at the end here. So that's how they spread the cost.
So you are only paying 5 years monthly instalments of £4,000.
Because they've put the final balloon amount at the end for you to pay.
Hope you understand that, because it took me a while to get my head around it. Now, with this balloon amount, you are left with 3 options at the end. You can choose to just pay the balloon amount at the end of the loan term and just keep the car. You can part exchange your vehicle for a new one or a better one. So if you were to decide to do that, you would literally take this £4,000 to a completely new loan, a brand new one. And what that will do is act as the new deposit for the new vehicle. So £4,000 will get taken off as a deposit for the new loan amount that you take out. Hopefully you guys are understanding somehow where we're going with this. Finally, if you do get to the end of the loan term and you just realise you don't need a car anymore, you do not have to keep that car. You can simply give the car back to the dealership and settle your account that way. Okay, so what we're going to talk about now is understanding your loan breakdown. You're going to need to understand 10 main things about your loan agreement. So what I'm going to do is we're going to go through a loan breakdown here to make sure that you understand every part of your loan agreement. If you already have a car on finance, then you should be able to read through your car finance document and you should be able to find the answer to every single one of these points. So first of all is your original goods price. Your original goods price is the value of the vehicle, so the total value. Whatever you see the car on sale for is the original goods price of the vehicle. Your advance payment is the deposit that you want to pay. Your initial loan amount will now be the loan that you take out. Your initial loan amount is the original goods minus the advance payment. Next will be the interest applied. As you guys know, on any car vehicle they will apply an interest. So this is the full amount of interest applied onto this amount of loan. An APR is basically an annual percentage rate, and that is the percentage version of the interest applied. So your total loan amount will now take into consideration your initial loan amount plus the interest applied. So in this case, it will be £9,500. And that will be the loan that you take out. Your loan term, as I've said before, is how long you want to take it out for. I do it in months because usually it's a monthly instalment. But monthly repayment will obviously then be calculated depending on whether you've taken out a hire purchase or a PCP. Balloon amount, again, as I've said, this is going to be necessary if you take out a PCP, is how much will be left to pay at the end of the 5-year loan agreement. The first payment date will most likely start 30 days after you have signed your contract. You can go back on your loan agreement and understand every part of this, then you are very much top class at understanding car finance. So I think I've equipped you guys with enough information for you to gain the basic understanding of how a motor finance works. Yeah, that's all from myself today, and I will see you next Sunday, in which I think we're going to talk a little bit more about cars, but I'm not too sure yet. But yeah, so anyway, take care. I'll see you next week, guys.